After this video, you will have better entries and less fake-outs that lead to randomly getting stopped out of your trade. Everything is explained step by step, and we are going to later test with a strategy on the charts, so let's get started. For this strategy to work, we need a bullish market on the higher time frames. The strategy is similar for the bearish market as well, but I've noticed it respects better if the high time frame trend follows an uptrend. Also keep in mind that in the long run markets tend to go up, so statistically just having more buys than sells can increase your win rate. So in case of a bullish market, we will see a bullish movement to the upside, as expected, which should be followed by a low volume downwards pullback. The psychology behind the pullback is that buyers are slowly closing their positions so they sell to the market, because of course they want to take profit. So this was the first group of buyers, let's call them buyers A. Then another group of buyers enter the market, Group B, and they buy the downside pullbacks, to eventually buying pressure increases so much over the selling pressure that the market starts pushing up to the upside again. Now this is very simple, and you probably already knew that, but it will help you a lot if you see the chart as psychological battle between buyers and sellers, instead of seeing just candlestick patterns. Because these movements mean something, and it's really important to understand the reasoning of as many candles as we can. Now the group of buyers B bring the market into new highs, and when the price breaks above the last swing high, we get what it's called a bullish break of structure. Now many think they know what these are, but most actually don't understand what really is a break of structure, so let's take a look at it. A price structure can be bullish or bearish. A structure is basically the price forming some kind of trending pattern. A bullish structure is a price forming higher highs and higher lows. So basically this entire price movement is one price structure. Well, the market has to break either the lows or the highs at some point. And when it does break the highs, the market enters into another structure that basically forms a similar type of movement that is still defined with a higher low and a higher high. And this is what continues an uptrend. Now this is very important to understand, because after each bullish break of structure, you will notice that the market enters into a pullback. And sometimes the market ends its pullback exactly on an entry structural level, like a demand in the case of a bullish market. And this basically gives us an opportunity for a buy-long position, with expectations that if the market has already formed a similar price movement, it has a higher chance to continue to do so at least one more time. But this is not what happens every time on the markets, because trading would be too easy, and we know that is not necessarily true. So having a more realistic price action would look something like this, where the market, instead of having one instant push to the upside, it has multiple mini uptrends, each with a mini bullish break of structure, and that moves to form a local high moment where the pullback to the downside is seen with multiple mini downtrends, with multiple mini bearish breaks of structures. So now traders here can do two big mistakes. The first one is that they're trading the mini trend itself. And this can be a huge mistake because the price action will not always look clean like this with the mini upside trend forming higher highs and higher lows. But sometimes the market will sweep liquidity from below and trap traders by basically breaking down below a previous low on a smaller time frame. And this forms what we call as a market structure shift. A market structure shift happens when a trend is reversing into the other trend. In this case of an uptrend, we have the shift when the market breaks below a last low. But the lows from the mini trends, which are also called as internal trends, it's not that important because I said, and you've probably experienced something similar as well, is that the market can simply just break below the lows. You become bearish because of that, but the market still ends up continuing the uptrend. So what basically happened is that you were right about the direction the market would move to, but you lost the trade. So the way to fix this is to look for the entry models only on the external market structure, only on the large time frame, only on the extreme levels. This way we decrease the chances that we will get trapped. So for example, if we see that the external trend just broke bullish structure, we mark the lowest point of that certain price structure. And we look for a demand there, and we just wait for the market to eventually pull back down into the demand with the internal downtrend, or mini downtrend, however you want to call it. Now when it pulls back into the high time frame demand, there is another problem. The traders that are not aware of the larger time frame trend see this entire price action as being bearish, so they trade the internal supply zones. They are essentially selling the market. And this can work with a very tight stop loss and take profit area. So maybe only for scalps on the 1 minute. However, this is dangerous because, as I said, the mini trends on the internal structure or on the low time frame trend can as well just sweep liquidity from above This does two things. It stops out sellers that have their stop loss above the internal highs, and gives incentives to buyers to enter the market because they saw the last high being broken to the upside. A high being broken during a downtrending price action is called a bullish market structure shift. And because this is not a downtrend on the large time frame, but it's just a pullback on the internal structure, this is called an internal market structure shift. But many traders are not aware of that, and they think this is a valid high time frame structure shift. And what they do is they buy the market at a near level. And what does often happen is that the market just takes out their stop losses and continues to move into the demand. You need to be aware that the market always chases liquidity, and the most liquid structures in the market are entry zones like high time frame supplies and high time frame demands. Or you can also call them support or resistance. They're not really the same, but very similar, and are usually met in the same levels. So we have patience for the market to pull into the high time frame demand. And now we have two options for an entry opportunity. We have the aggressive entry, and we have the conservative entry. The aggressive entry buying the market when the price hits the demand. This gets you more positions but with higher risk. And we also have the conservative entry where we wait for the price to react after it moves into the demand. The reaction that we want to see is a quick push to the upside that breaks above the last internal high, this forming an internal market structure shift. But we don't trade from the high time frame demand, but that is just used to see if the market starts having buying pressure. And if it does, it will eventually move into the higher highs on the internal trend. And at that point, we look for a demand on the internal trend, on the mini trend. And that is where we will take the buy position from. Basically, the conservative entry is about waiting for bullish confirmations to form. This gives you fewer opportunities and fewer setups, but higher quality ones with potentially higher risk to reward ratio setups. This is the Nasdaq on the 1 hour time frame. We start by analyzing the market, and that helps us in identifying the overall trend the market has followed and the possible trend that it can follow. So here we start with many bullish candles forming a local high, which is then followed by downwards pullback. But the pullback forms a higher low, followed by a continuation to the upside to break above the last high. So as we've seen in the first minutes of the video, this is an uptrend structure, and because of the upwards break for the new highs, we have the bullish break of structure at this level, and this is where it is situated on the actual chart. Now should also look and ask, why did the market bounce at this level? And that is usually because there was a high time frame demand, or a support when the market started pushing up. And if we look at the chart, this is the bottom of the initial move. And this is the level where the market has bounced to the upside. And if we look closely, there is a clear and simple demand, which is exactly where the market has filled the demand and started going up. And the entry model for the demand, it's quite simple. A buy-long position on the demand or support. Stop loss below the recent lows. Take profit at around 1 to 2, 1 to 3, or above structural highs. Now here we can see that it moved again into the demand zone, but has broken down below the last lows. So does that mean that this is a reversal into a downtrend? Well, not exactly, because this can also be a liquidity sweep to continue higher. This is not an external or high time frame structure shift because it did not break down below the extreme low being this one. So as long as the price is holding above this line, the market is still considered as being in an uptrend. And if we analyze the previous price patterns, it's clearly showing bullish pressure, with basically a repeat of the same structure. So a pullback, and then a break into new highs from where it forms the break of structure. Now here, the market actually starts pulling back down, forming an equal low instead of a higher low, showing early signs of weaker buying pressure since the buyers were not able to end the pullback higher. Followed by a lower high as well, and it's then where the market starts selling off with lower highs and lower lows. So this would look something like this on a price action presentation. But this is still a bullish market, and let's see why that's the case. So on the most recent price move that we can see, it's this specific second bounce from the extreme demand zone, and eventually respects our bullish bias, starting to form once again higher highs and higher lows. This basically reverses the low time frame trend with an internal market structure shift towards the bullish side. It just resumes or continues the high time frame move. And just like I explained in the first minutes of the video, after the market bounces up from the extreme demand, it means that it has validated the demand since it has reacted from it positively. In that case, we look for the next demand or support that forms, and this is the demand that triggers a buy position. with a pretty simple and straightforward setup planning, similar to the other demand. Entry on the demand. Stop loss below the recent lows of the demand, or nearly below the demand itself, and take profit at around 1 to 2, 1 to 3, or at structural highs. Now in this case we have two running positions, the position from the extreme demand, and this one that we've tested right now. And structurally what we would want is a break of all internal highs to eventually continue the high time frame uptrend by forming a bullish break of structure externally. And that happens only if the price breaks up above the extreme high. So this entire price action that you see on the chart has a starting low at this level, a swing high at this level, and the next swing higher low at this level. In case you don't understand, I will show here how that entire price action looks like. So on the swing levels, all we have is an upwards push, a pullback, and a continuation, basically a simple uptrend formation. But this entire price action is formed with the upwards push, which on the internal levels is seen with movements forming a mini uptrend, which sets the local swing high from where the market starts pulling back down. And many believe that this is a downtrend and they start selling. But this is nothing but just an internal downtrend, a mini downtrend, while the overall market is still bullish because it did not break below the extreme lows. But it has bounced up from a demand zone, or a support zone, to just later continue the uptrend by forming once again the mini uptrend that breaks into the swing higher highs. The red lines is how it looks on the internal level, and with the black lines it's what we see on the external level. So even if you see the market pulling back down here, that does not mean that it needs to bounce from each and every of these mini demand zones, but it will most probably bounce from the extreme demand. And if the extreme demand has already been filled 1 or 2 times, only at that point we can consider taking a demand from a higher level. Now, if we come back into the charts and play the price forward, we see that is exactly what happens. Basically breaking above the major swing highs to continue the uptrend on the external high time frame trend. So it's what I explained before, where we have an uptrend that breaks structure to the bullish side, to later start a mini downtrend on the internal price action, to eventually end the pullback and bounce right back to the upside from a demand or a support. And of course, this closes the second position on the internal trend with a win since it has broken up the highs. A pretty straightforward setup of buying the pullback and selling into the highs. So the extreme demand got filled and closed as a win. This demand also worked and closed with a win. So now the question is, from where is the market likely to bounce up from the upcoming pullback? Well, this upwards impulse forms another demand right up here, which is exactly above the recent one. But the problem is that we also have a demand right here, and we also have another one above. Which one will respect? The market hit this demand and bounce to the upside. Or it can break down below this demand, fill the one from below and bounce to the upside. Or the last one would be the market breaking down both of these demands and filling the last one and bouncing up from it. So the question is, which demand will actually respect? And the honest answer most of the times is that we can't know for sure. But we can take it logically and safely, usually only taking into consideration the lowest demand possible. So, the demand that is the closest to the swing lows, which is this one. And this invalidates the other two from above. So applying the setup planning, long position on the demand, stop loss below the lows of the demand, take profit at 1 to 3 should be fine. But what we can also do here is to switch into a lower time frame. The 15-minute is good enough, and we wait for the price to pull into the demand. If it goes higher and does not fill the demand, well, the best case scenario is that at least we didn't lose the trade. But the bearish pressure is slightly higher than bullish pressure. See how each internal push has been quickly sold back down, and that is because the market moves towards liquidity, and the most liquid zones are support, resistances, demands, and supplies. Now here we got the bounce and the position triggered. But what we can also do is to refine the setup and essentially use this as a demand confirmation that the market bounces from it. And what we look for is another demand formed from the bounce, where we actually place the position with the same logic. But in this case, we can even target structural highs. There is one important high, another one above, and the final one. This increases the risk to reward by a lot if we target these levels. But personally, I don't chase more to 1 to 3, or at most 1 to 4. Very rarely above that. Now here buyers finally stepped in, closing with a win, and it also took the first structural high. So the risk seekers got more out of this position. It even got the one from above, and probably the last one as well. But that would be way too high of a risk, and I don't like having the take profit so far away. This also works great for FX pairs, especially on medium and high time frames. So starting with the beginning of what we should do when we get into our desk and watch the charts. The first thing is analyzing the market to at least have a clear view of what is happening. In this chart, we see a market that initially has been increasing with lower volume, but then the candle sizes started getting larger and larger, but still holding a buying pressure, forming an uptrend. On uptrends, we look for demand zones. The extreme demands should be near the swing structural lows. For example, there is one demand right here. Make sure to fill all the wicks. And if we do so, we observe that this demand got filled right here. Now what you can also do is simply just trading the extreme demands without any in-depth internal analysis, but it's not often met when the demand fills so quick. It usually prints more price action before filling the demand. But as long as the price action holds a bullish break of structure, the buyers are still in control, and we have no problems in trading such simple setups. However, because of the demand being very large in this case, the stop loss and take profit targets will also be large, which is not necessarily a problem because the risk to reward is still the same. We target similar ratios, but it will take longer for the position to close. So price pulls back again into the demand, sweeping the liquidity from the last wick and instantly bouncing back up above the structural highs, which forms another bullish break of structure. And here, once again, the odds are towards us, since market has an increased buying pressure. Basically just respecting an uptrend structure of higher highs and higher lows, with their demand zones near each internal low. Now here the market is actually showing signs of weakness. Look at the lower high formation and the downwards pullback that is longer than the previous ones. So this might be the local high of a high time frame bullish structure. Basically this level, and what is more likely to come marking the local high, is a downwards pullback on the external high time frame, which could be this one on the chart. And that is this move on the presentation. Now remember what usually comes after a pullback. Well, the pullback has to end first, and that is where a question comes in. And that question is, where will the market actually end its pullback? Well, probably from a demand zone. But let's look at a demand on the left. There is one demand right here, another one, and another one. So how do we know from where the market will bounce, to eventually break upside structure and taking the market into new highs? Well, again, the simplest choice is just taking the most extreme demand from the bottom. Here we see that this pullback broke 1, 2, 3 demands to the downside, and looks like currently it has bounced from this one. Coupled with this descending mini downtrend on the internal level, we see that on the last move it broke above the last internal lower highs. So this actually has a very high probability of continuing the large time frame uptrend. But as I said before, the pullback usually ends because the price has filled a demand. And if we look to the left of the chart, it has bounced exactly from this demand right here. So we're actually late on this entry, but just to show you that even with the conservative entry of trading on the same time frame as the analysis, this probably still worked out. And yes, it did. Notice how it broke out above the major highs, marking the high time frame break of structure. Now after a high time frame break of structure, we expect a high time frame pullback once again. And where will the pullback end? Often on a demand zone. So let's look at how price behaves. The only demand we have here is around these price levels, so this makes it easier than the previous ones. Now we can actually find a setup from the beginning. The market fills the demand, and it consolidates near the demand. We can switch into a lower time frame now. We're in the 30 minutes. The time frame is not fixed. You can find setups pretty much on any time frame, just it has to be lower than the initial one that we've done the analysis. So now we are inside this consolidation on the high time frame demand. This entire price action would look something like this. This being the local high that we see on the chart, and this would be the consolidation at a demand level. A high probability would be for the market to bounce up into the highs and form a bullish break of structure externally on the high time frame. Well, that just means that we should now have a mini uptrend on the internal price action. And lately we see a bounce and increase in buying pressure. So what we do here is look for another demand inside the higher time frame one. That would be around this level, being the last downside candle before buyers started coming back into the market. And the setup planning is straightforward. Stop loss below the lows of the demand, and take profit if you're a risk seeker and only care about market structure. It can be above the structural highs, since we have a high probability of the market breaking above the highs to continue the uptrend. But because of the very high risk to reward, I usually won't go so far. 1 to 3 is more than enough. Position got triggered, almost got stopped out with a wick. That is why having a smartly placed stop loss is important. And soon after the buyers took control, essentially pushing the market towards the highs and closing the position with a win. Now it's also important to know that this is enough to become profitable, but when it comes to sustaining it, it's more challenging. That is where my ebook and trading materials that you can find both on the link in the description can make a huge difference, and as well as my free YouTube videos. So thank you for watching and have a great trading session.